Good morning and good afternoon, everybody. For those that are out in the Central Coast and East Coast as well, thank you for coming out and joining us this afternoon, this Friday. I appreciate you taking the time out of your day. There's many other things that could be done on a Friday afternoon, Friday morning, so I appreciate you taking the time to learn about audits, learn about what they entail. For those that are plan sponsors that are joining us, welcome. This is a timely presentation for you as you're about to embark on your first 401k audit. Hopefully this presentation will give you the confidence and just more, reduce any anxiety or any worries or stresses that relate to that first audit. We know how that can go, so we appreciate you taking these 45 minutes to join us. And then for service providers as well, thank you for coming out. It's great that that you're spending this time as well just to sharpen your skills, to be able to generate more information, collect more information to be able to pass that on to your clients as well who are about to go through this first audit, or even, new individuals that maybe plan sponsors have had audits in the past, but are just transitioning into a position to where they're administrating plans themselves for the first time. So very, very happy to have you. So today we're going to talk about preparing for your first plan audit, a survival guide. My name is Alex Sanchez. I'm here with Todd Hallowell today, this afternoon, this morning. He is a fellow practice leader and colleague. So what is a single service accounting firm? As it says in the slide, we are a single service accounting firm. What does it mean? So what it means is that all we do in singular focus is all spent on 401k, defined contribution, defined benefit plans. That is all we do year round. So we don't do corporate audits, we don't do corporate taxes. This is what we do 365 days out of the year and what we focus on. Power of focus is what our motto is. Pension Assurance was founded in 2014 with the vision to create a single service accounting firm exclusively focused on retirement plan audits year round and firm-wide. So it's our only revenue source. The experience that we have, we notate it here. In 2021, we audited 670 plans. I can see we're projecting out to about 700 to 750 by the end of this year, with 12 billion in plan assets and over 210,000 participant accounts. Like to share our vision and our mission. So our vision to become a national leader in the area of retirement plan audits in quantity, quality, and subject matter expertise. A lot of we were founded and started in LA region, basically California. We've got I'd say about 95% of our plans leading up to probably a couple of years ago were in the state of California. We're the second largest EBP practice. We have the second largest in California, but we're becoming more of a national presence in that we've got boots on the ground elsewhere outside of California and are growing, and that's really the vision there. Our mission to deliver value and education to our clients through our retirement plan audit process by cultivating a team of experts that provides the highest level of service and efficiency. What to expect today? So here's a little recap of what we're going to be talking about this morning and afternoon. When a plan audit is needed, right? So this question tends to come up very often for us, whether it's a plan sponsor who has not gone through an audit before and they're wondering why they're getting this audit requirement, or a TPA who's maybe got a question, or service provider that maybe has an inquiry, probably get this question about at least 10 times a year. So we'll go through that and try to uncover any questions there. Selecting a plan auditor and the importance of, as a fiduciary, to make sure that you're exercising proper due diligence when it comes to selecting a plan auditor. View an audit quality study that was put out. The latest study that was put out by the Department of Labor on audit quality was in 2014, and we'll talk about that. Documentation needed during the audit. So these are kind of the answers to the test. So you'll have a good gist of what we require, what we ask for when it comes to these audits. how your plan service provider can help. We're always trying to leverage our service providers, so we'll talk about how we do that. Common audit findings. So these are issues that tend to pop up during these audits. So we'll share those as well, so you can be prepared. Hopefully, none of them are things that you're dealing with now, but if so, you can address them early on. Audit timeline. We'll talk about the timeline from beginning to end and how that works and how long the expected turnaround time should be. So first thing, how did this happen? How did we get into this requirement, right? Sometimes I get phone calls from plan sponsors saying, we only have about 20, 25 participants. How did we get this requirement? Why did this, how did we surpass the 100 threshold, right? So the important thing to note is that it's based off the beginning of year head count. So that number ends up on your 5,500 form. And that count entails, if you look at the asterisk on the lower left-hand side of the screen, that count really includes all active and eligible employees. So a couple things here. Beginning of year head count is important. So sometimes I'll get a call saying, hey, we had 99 participants at the end of the year, so we're good, right? But no, that's not necessarily the case. That ending number that is on your 5,500 doesn't really translate to, or always translate to, the beginning number of the following year. Just because you might have a provision in the plan where eligibles, you might have additional eligibles that start as of 1/1, right? Based on if you have quarterly entry dates or annual entry dates that first of the year. So it might prop you over that threshold. So that participant account again includes actives, eligibles, and then thirdly, people who are either retired or separated from the plan and still have account balances. I think this is a good point to bring up, just because as a service provider, you might be able to help out your clients in being able to clear out those small balances that are in the plan. Oftentimes plan documents will have a provision for force outs for any plan that has less than $5,000 in accounts for people that are separated from the plan. So by practicing this and cleaning out the plan every so often, if you look at it on an annual basis and send those notices out and get that done, you can keep that number down as far as the administrative costs and the headcount down by doing that. Sometimes you can't avoid it. It's unavoidable. You're going to need an audit no matter what. But when you're at that point, you might be able to save a year or two worth of audits by doing this. So something to think about. The general rule of thumb is 100 participants, but there is an 80-120 rule, which many of you are aware of. The 80-120 rule is basically allows plan sponsors to push off the audit a few years. So for a growing company, let's say if you're between 80 and 120 in the previous year, the DOL allows you to postpone the audit and waive the audit until you go over 120. So example one clearly kind of shows that. So if you have a participant count of 118, you filed as a small plan in the prior year, so say 2020, you can still waive that audit for 2021 if you're still under the 120. So the magic number for that first initial audit is really 121. In example two, it's a different scenario where you had 118 in the prior year, but then you jumped to 122 participants and filed as a large plan, right? So once you go over the 120, that's when that initial audit really comes into play. After that, the general rule of thumb would come into place. So that's where the 100 comes in. So you wouldn't be able to bypass the audit until you're at below 100. The other couple of things to note here is that you got mergers and acquisitions, right? It happens all the time, especially now more than ever. So let's say you have a merger, you acquire a company, you merge in a plan in the middle of the year. Just remember that the count is based off beginning of year, right? So if you have an acquisition and it starts as of 6/1 or 7/1, then those participants would not be included in that count. It would basically be only if you had that acquisition and the merger resulted in increase in headcount as of 1/1 of that given year. The other caveat, the other thing that comes up is the plan inception date. So if, let's say, it's a new plan set up in 2021, the 100 eligible participant count, it doesn't, or the 80-120 rule doesn't apply because there is no prior year to go off of. So that's where the general rule of thumb of 100 comes into play. If you have over 100 at the date of inception, then you're going to have that opening audit requirement for that given year, that short period. So that's something to keep in mind. Selecting an auditor, aren't they all the same? Oftentimes, plan sponsors will just go straight to their CPA to see if they can handle their corporate audit. But it's important to know that ERISA audits are completely different from financial statement audits. So it's important to do your proper due diligence, ask the right questions, and know that somebody who handles corporate audits, corporate tax work, isn't necessarily going to know how to perform an efficient and proper ERISA audit, just because they are governed. It's governed by completely different standards, and reporting is completely different from what you're used to seeing on a financial statement audit. Retirement plan audits have become increasingly technical, specialized, and regulated. It's something that has just continued to happen year after year. We'll talk about some new regulatory things that have come up, and it's just that coming from the DOL, coming from ERISA, the IRS, it's coming from all over. Many CPA firms, because of that, are exiting the retirement plan audit industry due to the regulatory pressure. It just doesn't make sense for firms that are doing a few plan audits to pursue this industry just because there's so much to learn and understand when it comes to these audits. There's DOL work paper inspections. They can have a serious consequence on the firm's audit practice. So if deficiencies are found with these DOL inspections, the DOL can reject a filing that if it did come up, may require a re-audit. So that can add up, be expensive, and it just takes time away from your company, the HR team, the finance team, everyone involved. And then there's also peer reviews. So these are performed by another CPA firm, and in recent years they've been pressured as well to go through an exhaustive checklist of items, and that checklist just keeps growing and growing. So as they're doing these peer reviews, there's just high level of scrutiny when it comes to them coming into CPA firms and looking at a sample of their audits on the EVP side. So just things to be aware of. And so, as you're seeing, for those service providers that are seeing the prices of these audits going up over the past 5 years, this is really the reason, a major reason why. Statistics as they relate to the Department of Labor and the audit study that was recently done in 2014, most recently, you can see the deficiency ratings have gone up drastically over the years. And so this is really why we exist. We feel like, this is where the Department of Labor, they're harping on audit quality, and the fact that there's deficiencies with these audits, and specialization is key when it comes to minimizing these deficiencies. And so that's why we're here today. That's why we're talking about this. Here's a table that just expands on that previous slide. So you can see experience matters. Specialization significantly improves audit quality. If you look at the first column, you see these are the number of plans that CPA firms were auditing. This was back, these are stats that were put together in the 2014 study. So you can see there's a direct correlation between the number of plans that firms audit and the audits with deficiencies on the far right of the table. So if you have a firm that audits 1 or 2 plans, you would see that the deficiency rates were sky high, right? 75.8%. It's pretty unbelievable to see. When you hire a CPA to handle your 401k audit, you would expect that they know what they're doing. Just like when you hire any service provider to come in, you would hope that they'd be able to do the job that you hire them for, right? So it's important. Again, oftentimes CPA firms will take on the audit as a favor for their client, and pick it up and be, have the greatest intent. But again, it's really on the plan sponsor as a fiduciary to make sure that you're hiring the right service providers. And that's not just only on the audit side, but any type of service provider, whether it's an advisor, a TPA, a record keeper, and so forth. So as you go down the list, you see it doesn't really get much better. 3 to 5, 6 to 24 range, 25 to 99. You really don't get the efficiencies and the effectiveness until you get to over 100 plans. So if you have a firm that you're interviewing, you want to ask those questions: how many plans do they audit a year? We don't like to see any deficiencies, right? So the 12% is still kind of alarming. And again, that's why we're seeing more peer reviewing, more scrutiny from the Department of Labor. And so, we're trying to improve this as an industry. And hopefully with the next study, we'll see the numbers come down. Here on the next slide, we just recap the fact that there could be a potential rejection of the Form 5500. So we, over the years, have picked up plans like this where a client will come to us and say, hey, we did an audit for the previous year, or even years back. It could be that it was 3-4 years ago, and the client's getting a notice from the Department of Labor saying, the audit was deficient, the filing was deficient, and that particular year and going forward needs to be re-audited. And it's to go back and to pull up that documentation, to go through payroll records, to go through that process again is arduous to begin with. But to go back that far and to pull in the team, HR team, finance team, to get this done can be not only costly from a dollar standpoint, but just also from a time standpoint. So it's better to do things right from the beginning. Try to not cut corners, and just make sure you document, who you hired, why you hired them. All those things are extremely important. So in case it ever gets contested in the future. The RFP process. So we talked about documenting. Document the decision making. This is important. So what are the questions that you'd want to ask, right? So you've never done this before as a plan sponsor. What should we be asking auditors before hiring the right CPA, right? So again, number and types of plans that the CPA audits. Just want to make sure that they know the space well. The other thing with that first bullet point that I wanted to point out was, you want to know how many offices do they have nationwide? Are these, if they say that they do 50 plan audits, for instance, right? Are those done out of one office, or are they done, is it a nationwide business where they've got offices throughout the country? And, maybe they have a couple plans here, a couple plans there, and it's not really centralized. So the decision-making and the operation is done at a local office level. So you want to find out what is the level of expertise from that office where the work is going to be done, right? So that's something to keep in mind. Amount of plan-specific training the CPA has. So just to give you an example with us, because it's 100% of what we do, all our continuing education for our people is focused on employee benefit plans, right? And our audit practice. So we're not focused on, auditing financial statement audits, nonprofits, or, most of the time when you've got a firm that's a full service firm, they're doing most of their training on the higher risk areas of their practice. So more of the corporate work, corporate engagements, they're focused on training and educating in that regard instead of the 401k. Maybe the 401k gets a little bit of training, but not as much as you would if you had a specialized practice, right? So firm's commitment to plan audits. What percentage of the firm's revenue is from EBP? Another good question to ask. specific team experience who will work on your audit. You want to make sure that the people that are actually doing the work are going to be experienced and maybe not interns or first-year staff coming out of college. You want to make sure that the people that are touching your records, giving their opinions, giving the advice, are people that are experienced, that have done this plenty of times before. Status of the CPA license. This is another thing you can check with the State Board of Accountancy, just to make sure that their license is in good standing. Whether the CPA has been subject to prior DOL findings. Have they been investigated? Have their work papers been reviewed by the DOL, and how did that go, right? So that's another question you can ask. And then the audit fees. The audit fees shouldn't be the only reason or the only thing you consider when picking up a service provider, whether it's on the audit side, CPA, or any service really. Like, you want to make sure that you're doing your due diligence, that you're hiring and paying for services that make sense. You don't want to choose just the lowest cost provider, but you also don't want to overpay as well. So, sometimes we run into situations where a plan sponsor really values the name. And so maybe they go with, say like a big national Big Four firm to handle their 401k audit, but, does it really make sense to pay the extra tens of thousands of dollars to have that, if you can find an alternate solution that's not as expensive and you're still getting the same level of expertise, right? So those are all things to think about. It's always good to get feelers out there, send the request, the RFP out to a couple names that are referred in, where you leverage your service providers to give you that advice. And then really, we have a template ourselves, but if you ever need it, we can send that out of questions that you can ask. But these are just some questions, and we've seen RFPs that could be a page long all the way up to 15 pages long. So it's really whatever you need to gain that comfort. ERISA Section 103A3C audit. So this is a new term that just came out through our latest standards. These used to be known as limited scope audits. So, for everyone on the phone, service providers, or on the Zoom meeting webinar, has probably heard the term limited scope and full scope before. This is a term that for years, limited scope is now going to be replaced by this 103A3C audit terminology. And this terminology, what it basically means is that we've done less work than what we usually do, right? So limited scope, full scope, from a limited scope standpoint now, ERISA Section 103A3C, it basically allows the auditor to ignore testing investments so they can focus on testing participant accounts. It also helps keep fees down for clients. So to put this in simple terms, if you have a qualified financial institution that handles the record keeping custodial activity for the plan, they put out this complete and accurate certification letter that says, the trust reporting that's included in the audit package is complete and accurate, right? If that letter comes from a qualified institution, it basically allows us to perform a limited scope, now called a ERISA Section 103A3C audit. And so that's what that is. And it basically allows us to bypass investment testing and the earnings, so investment balances and the earnings associated to those investments during the year. And that's only because you've already got those companies, the John Hancocks of the world, the Principal, Fidelity, ADP, these record keepers are already audited at their level. So why have thousands and thousands of auditors coming in doing these individual plan sponsor plan audits and testing those same investments and the earnings associated to those investments, right? The important thing with these audits is to make sure that you're testing participant accounts. So there's a lot of other activity that can be looked at instead of repeating work that's already been done. And so you see in red at the bottom, participant transactions, participant data, anything else that doesn't directly pertain to investment valuations are all still in scope. So you're testing contributions, distributions, vesting. And so there's a lot that goes into it. And so we'll keep going here. I'm going to transition this over to Todd, who's going to talk about leveraging your service providers and more.
Thanks, Alex. I'm Todd Hollowell, one of the practice leaders at Pension Insurance. So the first thing I want to talk about is, your service providers and how you can leverage the audits. Basically, 75% of our requests you can get through the service provider. So we try to streamline it as much as possible for you. And the three main service providers that you can get information from are first your financial advisor. They're probably going to have the meeting minutes. You might also have your plan documents. And then if you're an unbundled plan, you might have a TPA. They're going to have copies of the plan documents, the loan reports, your draft 5500. And then you also have a record keeper or custodian, and they're going to have the audit package, which is basically, the trust reports for the year that we need for the audit at the plan and participant level. And then as a plan sponsor, you're going to need to provide us with the deposit schedule, copy of the fidelity bond, access to payroll registers, bank statements, and personnel files. Let's see, there we go. So the next slide here, this is an example of our schedule request for a plan audit. As you can see, we try to streamline it for you by who's going to provide what information. So the first column there, you have the plan sponsor, and you'll see we grade out the items that you don't need to provide, such as the audit package. And the next column would be for your custodian or record keeper, then your TPA, and then your financial advisor. And then the next slide here is for first year plan audits. There's some additional information that we'll need from you, such as your prior year 5500, copy of the fidelity bond, and then we'll also need the prior year payroll reports. So for example, we're doing 2021 plan audit, we need the 2020 payroll reports. And we'll also need the prior year trust statements and non-discrimination tests. And you might ask, why are we asking for prior year information? We have a slide coming up about that. So here's an example of our deposit schedule. And as you'll see, the first four columns in pink there are from your payroll register. And we'll need you guys to prepare this. And it basically has, by paycheck date, employee deferrals, employer match, and loan repayments. And then the blue columns, that's from either your record keeper or your bank statements. And it has, the date of deposit and the amounts. And we need this because we have to look at time listed contributions as part of the plan audit. And on occasion, you'll see we'll have some variances, and this is usually due to if you're using forfeitures to offset the match, and that's fully acceptable. And then one thing to keep in mind, if you're already keeping track of this and you have an Excel schedule, you can provide that to us, and there's no need to fill out our template. So as I mentioned before about beginning balance test work, why are the auditors asking for prior year information? Well, the audit standards require us to do initial evaluation of the opening balances of the plan, and basically gain comfort over those opening balances, make sure there's no material misstatements, and make sure that the accounting principles have been consistently applied. And so one of the things we have to do is we have to get comfortable with those closing balances from the prior year, kind of do a roll forward to the current year, make sure those are appropriate, and look at your accounting policies as well. And we have to also gain evidence in the current year of those opening balances. So we can do it one of two ways. The first way is if the plan was audited by a previous auditor in the prior year, we'll review their work papers from the prior year. But that's probably not the case for most of you on this webinar. In that case, that's where we gain evidence by looking at those prior year payroll reports and those prior year trust reports and doing some additional testing. And so what are some of the common audit findings we find in our plan audits? The first one we see quite often is late contributions or inconsistent contributions to the plan. Now that you're a large plan, there's not that 7-day safe harbor that small plans receive from the paycheck date. As a large plan, it's definitely more subjective on what is considered late. If you're ever to get audited by the DOL as a large plan, they kind of come in and look at how quickly you typically get your contributions remitted to the plan. So for example, let's say you typically remit your contributions within 2 to 4 days, and they see, well, you have these outliers of 8 days, 9 days, or 10 days, and they would consider those potentially late. You'd have to remit lost earnings to the plan. So, and then the other key area is not following your plan document. This is pretty important, as the premise of tax qualification of the plan is based on the set terms in the plan document. And as part of the audit, we have to make sure that you're following the terms of the plan document. And the first key area there is, we see quite often issues is with definition of plan compensation. And for example, let's say your plan document is based on W-2 wages as plan compensation. You don't have any exclusions from plan compensation, and we were doing the test, and we see bonuses. No participants were allowed to defer on bonuses, and so obviously that's an exclusion from plan comp, and that can be a costly error because you have to look at everybody for the year and go back, for prior years to correct as well. And one thing we recommend there is whenever you have a change on payroll provider, that you make sure that those payroll codes are updated, to be in compliance with your terms of the plan doc. And also if you, have a plan restatement, which I think a lot of you might have went through this past year with the restatement cycle, is just check the definition of plan comp and make sure that's how you're operating. Then obviously we'll look at eligibility. Typically, say your plan has a 3-month wait period for entry, making sure that's correct. We'll also look at vesting with distributions. And then also, some other areas we see is just not following participants' instructions, deferral elections. We used to see this more with the paper forms where somebody elects 5%, but let's say they only got 3%, which didn't get updated in payroll. And then maybe they signed an enrollment form, but they didn't get it into the plan. And the last one we're seeing more often now that more plans are allowing the auto enrollment feature is just, some participants are getting missed being entered into the plan. So the audit timeline, how long does it typically take to do the plan audit? Typically for us, we have a 6-week cycle from when we get the audit package. We can be flexible with this. If we get the audit package and it's a busy time of year, there's some flexibility. We can kind of push the dates back. And typically we try to do it within 6 weeks. In the first week, we obtain and review the audit package. We'll send out selections. We'll schedule a date for the remote field work. And then week 2, it's more internal items for us. We're performing analytical procedures, getting our work papers together, draft financial statements. One thing we'll do during that week is we'll reach out to you to have it document your internal controls. And we'll have maybe a 30-minute call with you just to document your processes related to the plan, related to payroll, related to remittance to the plan, etc. And then kind of week 3 and 4, we're prepping for the field work, answering any questions you have about our request. And then week 5 and 6, we're wrapping up the work papers, finishing up the test work, the field work, getting the plan through our second review process, and then sending you the draft financial statements. So what are some major correlations with audit quality? Alex talked a lot about the audit quality study previously. And so, looking at pension insurance, so those, providers or CPA firms audit more than 100 plans annually, have better quality. We audit over 600 plans annually. And then, those firms that have greater focus on plan audits, 10% or more revenue from plan audits, had better quality. Well, it's 100% of our firm revenue. It's all we do. And then one of the things they also said that had better quality was engagement firms, partners who had more than 24 hours CPE annually. Well, all our staff and partners have more than 40 hours a year annually in training. And then, some other things that set us apart from other CPA firms is, we have a very efficient and streamlined audit approach. It's all we do. Clients love us for not making their lives difficult. We work with all the different custodians, record keepers, all the different payroll providers. And then, if there's an issue that comes up in the audit, we most likely have seen it before, and, we can help you work through that problem. Then obviously we hire experienced professionals, and your key point of contact for the audit will be at least a supervisor, manager, or above. So you're not going to have to deal with any brand new auditors and have to train them up. As as Alex mentioned earlier, we get a lot of clients who come over and say, hey, I have this brand new auditor. Last year I was teaching them about a 401k plan, so you don't have to deal with that. And then obviously it's our exclusive focus. It's all we do is plan audits, and it's our highest level of commitment. And then one thing I wanted to bring to your attention, it's kind of looking forward a little bit, is with the Secure Act and the long-term part-time employees. And that's basically those participants who work between 500 and 900 hours a year. And with the Secure Act starting in 2024, those long-term part-time employees that work more than 500 hours for 3 consecutive years, you have to allow them to participate in the plan to make deferrals. You can't exclude them from match if you want. We just want to bring it to your attention so that way, you know, beginning of 2024, you're not like having to go back 3 years and look at all your reports to figure out who should be included. There are some options. You want to avoid that headache. You know, you could go ahead and permit those part-time employees to being participate in the plan at an earlier date, and you need to amend your plan to allow the part-time employees to participate in the plan. But it could, you know, reduce your administrative load there. And another thing to keep in mind with the Secure Act and check with your vendors is you need to make sure and amend your plans for the Secure Act by the end of 2022. And I think that's it. And if you guys have any questions, we provide our contact information here for myself and Alex, and you can scan those QR codes. If you want to reach out to us on LinkedIn, we have our phone number and our website there as well.
Thank you, Todd. Thanks, Todd. A couple of things I wanted to mention here as we look into the future. I touched on the Statement of Audited Standards 136. It's a new pronouncement that came out, and I touched on the change from limited scope language to section 103A3C. So with that, because this is brand new, it's actually the standard that rolled that out was effective originally for periods after December 15, 2020. However, that got pushed off to 2021. So it's going into effect now. So for those of you who have gone through audits in the past or have seen, you know, the reporting a certain way, whether it comes to engagement letters or management letters or financial statements, they're going to look a little different now going forward because of SAS 136, this new standard that came out. So look out for an invitation for the next webinar that's coming up on April 26th, where we'll dive in and talk about that and how it'll affect plan sponsors, service providers in the future. So and it's actually going into play now as we speak. So that correspondence, the information, it's all going to look a little different. But we'll talk about, you know, the responsibilities and how it affects everyone. You can log on to our website and register there now. There's a link for that, and that's on Tuesday, April 26th. And then I know there's been a request for slides today, so we're happy to share those slides with you. And if you've got any questions, just reach out to either Todd or I. We're happy to share those slides and anything else if you've got questions.
Alex, we have one question right now.
Yeah, go ahead.
Is there a range you can estimate a plan sponsor should expect to pay for an audit?
Yeah, that's a great question. Comes up all the time, of course. So with us specifically, it really is going to range based on the complexity of the audit, the head count, number of payrolls that are feeding into the 401k plan, the record keeper that you're working with, whether there were any transfers or mergers in the year, whether there are mergers going out or mergers going in. Just to give you an idea, I'd say our baseline fee right now is about $10K, and it just goes up a little bit from there depending on the situation. So we find that it's, you know, it's very reasonable considering what you're getting with regards to just the level of expertise that you're getting, whether you're in whatever market that you're in. We find that it's reasonably priced, but you're always welcome to compare pricing, give us feedback, let us know on that. We're always willing to work with plan sponsors. So thank you for that question. Appreciate that. Any other questions come through, Chris?
That is all for now.
Excellent. Well, thank you everybody again for joining the webinar. Appreciate the time. Have a wonderful weekend, and we'll talk again soon. Thank you.